Investing feels complicated. I get it. You hear people throwing around terms like PE ratios, blockchain forks, and yield curves. You see charts that look like they need a PhD to read, and then some headline screams that the market just crashed 30%, and you think, yeah, man, I'll just keep my money in a savings account, thanks. But here's the thing, underneath all that noise, the actual principles of smart investing are surprisingly simple. And once you understand them, a lot of the fear just falls away. That's what this video is about. Not jargon overload, not insider secrets, just the core rules that separate people who build real wealth from people who stay stuck. If you've been following this series, we've covered a lot of ground already. Shifting your mindset from the quick wins to the long-term thinking, learning the difference between assets and liabilities, understanding why looking rich is not the same as being wealthy. This video is where the rubber meets the road. How do you actually take your money, however much or little, and start putting it to work? Think of it like fitness. You can buy the fanciest equipment, follow every new trend, but the things that actually get results are just the basics: consistency, good form, progressive overload. Investing is exactly the same. The fundamentals always win. So let's lay that foundation. The first principle is diversification. Don't put all of your eggs in one basket. It sounds really obvious, but you'd be amazed how many people ignore it. The idea is to spread your money across different types of investments: stocks, bonds, real estate, precious metals, maybe even some crypto. This is so that if one area takes a hit, your entire financial life doesn't collapse with it. I learned this one the hard way. During the ICO mania of crypto, nearly everything I had was in speculative assets. When that market crashed, I was completely exposed. No safety net, no cushion, just a portfolio that moved in one direction, down. Over time, I learned to balance. Even when I had strong conviction in something like Bitcoin, I made sure I held other things that moved differently, stable things, things that wouldn't all crash at the same time. In the gym, you wouldn't just train chest and ignore everything else. You'd end up imbalanced and probably injured. Same logic. Diversification is your hedge against the things you can't see coming. The second principle is risk management. And this one is really about knowing yourself. Every investment carries risk. That's not the problem. The problem is when the level of risk in your portfolio doesn't match what you can actually handle. Some things are high risk, such as startups, small cap stocks, obscure altcoins. They can deliver huge returns. They can also fall off a cliff overnight. Then you've got medium risk, established companies, index funds, something like Bitcoin if you can handle the swings. And then lower risk, government bonds, money market funds, stable real estate. Smaller returns, but fewer nasty surprises. The goal is to not avoid risk. You can't. The goal is to find a level where you can still sleep at night. If you're lying awake worrying about a 30% drop, you've taken on too much. Scale it back until you can think clearly. And be honest with yourself about this. It's easy to feel brave when everything's going up. The real test is how you react when it's going down. Third, compound interest. This might be the single most important concept in all of investing. We've touched on this before, but it's worth hammering home because it's the engine behind everything we're talking about. When you invest consistently and reinvest your returns, your money doesn't just grow, it grows on top of previous growth. That snowball effect over years and decades becomes enormous. You don't build serious strength from one gym session. You build it incrementally, rep after rep, session after session. Investing works the same way. Each contribution stacks on the last, and the earlier you start, the longer the snowball has to roll. If I'd started investing even small amounts during my partying days instead of burning every paycheck, I'd be in a very different position right now. That's the cost nobody talks about. The compound growth you give up without even realizing it. Starting small is fine. Starting late is okay. But starting is everything. And the fourth principle, long-term thinking. Patience over panic. Markets go up and markets go down. There will be periods where everything feels amazing and periods where it feels like the world is ending. That's normal. That's how markets work. A long-term investor looks past those cycles. They know that assets with solid fundamentals tend to appreciate over a decade or more, regardless of what happens in any given month. So you buy quality, you hold through the noise, and you adjust as your life changes. Maybe your risk tolerance shifts when you start a family. Maybe you rebalance when you switch careers. That's fine. But the core approach stays the same. Disciplined, steady, patient. You're not trying to win this quarter, you're trying to win the next 20 years. All right, so those are the principles. Now let's talk about how you can actually put them into action, because knowing this stuff isn't enough. You have to build a system. Step one, get your baseline in order. That means paying off any high interest debt first. Credit cards, predatory loans, the interest on those almost always outpaces whatever you'd earn from investing. So kill them first and free yourself. Then build an emergency fund. 3 to 12 months of living expenses sitting in a savings account you can access quickly. This is your safety net. It means you'll never be forced to sell investments at a terrible time just because your car broke down or you lost your job. Step two, automate your investments. Set up a recurring transfer every month. A fixed amount goes straight into your brokerage account or crypto wallet. Dollar cost averaging, we've talked about this before. It removes the emotion from the process. It builds consistency, and over time, it's one of the most effective strategies there is. If you hold dividend stocks or funds, set them to reinvest automatically. Let those returns compound instead of sitting idle. Think of it like scheduling your own gym sessions. It happens whether you feel motivated or not. That's what makes it work. Step three, diversify. Not randomly. You don't need 100 different stocks or a dozen obscure crypto tokens. That just dilutes your returns and makes everything harder to manage. Aim for balanced coverage. Some equities or an index fund, some property if it's feasible, a bit of gold or crypto if it fits your risk profile. Quality over quantity always. Step four, review and rebalance. Check in on your portfolio quarterly or yearly. See if your allocations have drifted. Maybe crypto has surged and now it's half of your portfolio when it was supposed to be 10%. That's a signal to rebalance. Take some profits, redistribute. And as your life changes, your strategy might need to shift too. New job, family, retirement getting closer. These things change your priorities and your risk tolerance. And that's normal, and adjust accordingly. Step five, never stop learning. Markets evolve, technology shifts, governments change policy. The investors who do well long term are the ones who stay curious. Read, listen, talk to people who you trust. Keep your mind open and keep refining your approach. And one more thing before I wrap up. Not all investment is financial. Investing in yourself might be the highest return move you could ever make. A new skill, a certification, a course that opens the door to a better career, that's an asset. It increases your earning power for years. And your health. We've covered this earlier in the series. A healthy body lowers medical costs, boosts energy and productivity, extends your best earning years. You could argue your body is your single greatest asset. Don't let it fall apart while you're busy watching stock charts. So that's the foundation. Diversify, manage your risk, let compounding do the work, think long term, automate, keep learning, and invest in yourself along the way. These principles don't change whether you're investing £100 a month or 10,000. They're the bedrock. In the next video, we're going to go deeper on where to actually put your money. Stocks, bonds, real estate, gold, Bitcoin. We'll break down each one. what it's good for, what the risks are, and how I personally think about them. If this was useful, drop me a comment. What's the investing principle that most clicked for you? Or what's been holding you back from getting started? I'd love to hear it. Like, subscribe, hit the bell, and for the full playlist, that's going to pop up at the end of this video. Thanks for watching, and I'll see you in the next one.